Look closely at this chart. The top lines track the S&P 500 and Nasdaq pushing through record highs, fueled by massive spending on artificial intelligence. But cutting straight through that optimism is a sharply rising line. JP Morgan's calculation that we are currently facing a 35% probability of a localized recession. To understand that gap, look at the metric flatlining across the bottom. United States consumer sentiment has dropped to 44.8. Everyday domestic consumers are separated from the tech rally, drained by elevated grocery receipts and residential rental costs. Historically, you expect these kinds of domestic financial pressures to evaporate when a major global military conflict resolves. When geopolitical tension drops, international markets usually expand together. We are actually seeing that resolution right now. A historic United States-Iran interim ceasefire framework is officially in place, ending a grueling 4-month blockade of the Strait of Hormuz and allowing commercial tanker traffic to resume transit. Yet, the expected global relief rally never arrived. Instead, the global economy is splitting into two different realities. The benefits of newfound maritime peace are colliding with an unyielding wall of aggressive financial policy. The immediate benefit of reopening those Middle Eastern shipping lanes is obvious. Energy commodities act as a massive pressure valve for the global economy, and free-flowing oil means cooling inflation for net importing nations. This chart tracks the exact scale of that deflationary relief. You can see Brent crude futures plunging from their conflict peaks, finally settling near the $80 per barrel benchmark. But the open water is a deceptive indicator. Widespread legislative tariff increases imposed by the United States are distorting cross-border corporate playbooks, injecting friction into international supply chains. Manufacturers across both advanced and emerging economies know these tariffs threaten their profit margins. To hedge against this persistent policy uncertainty, they are rushing to buy and ship their raw material inputs right now, before the trade barriers worsen. That defensive stockpiling has triggered intense demand for massive commodity transport vessels, pushing the Baltic Exchange Dry Bulk Freight Index up more than 2% to a significant seasonal peak. The net result is a zero-sum collision. The macroeconomic relief provided by cheap fuel is offset by the expensive, panicked scramble to move physical goods ahead of the coming trade walls. While industrial logistics face a physical bottleneck, financial markets are dealing with an entirely different roadblock constructed in Washington. Western central bankers are looking right past the drop in energy costs. They are fixated on a much more stubborn domestic metric, underlying consumer inflation. It remains uncomfortably high, tracking near 4.2%. Facing that upside price risk, Federal Reserve Chairman Kevin Warsh held the benchmark funds rate at a restrictive 3.5 to 3.75%. He dialed back any expectations for near-term cuts and warned that future rate hikes are firmly on the table. This seesaw graphic illustrates the resulting mathematical trap. When central banks lock their interest rates high, governments and corporations still need to borrow massive amounts of money. To attract investors to those long-term loans, the required payout, the bond yield, must rise. That restrictive posture has triggered a coordinated fixed income sell-off across advanced economies. Long-end sovereign bond yields are shooting up, erasing months of post-pandemic normalization. This specific collision is what generated that JP Morgan warning. If bond yields stay elevated, they will limit the borrowing liquidity that mid-sized corporations rely on to survive, serving as a primary driver behind the recession warnings. Global corporations are recognizing that the specific advantages of the last decade, predictable trade routes and cheap borrowing, are being replaced by a period of structural friction. To manage persistent tariff exposure, these companies are actively moving away from traditional, labor-heavy international supply chains. They are physically shifting their logistics to reduce their vulnerability to border taxes. The evidence is in the import data. We are seeing a 30% surge in capital goods imports, driven specifically by the purchase of heavy industrial machinery and automated factory tooling. To navigate a bifurcated economy, businesses are aggressively rewiring their physical production lines, substituting international human labor with localized robotic automation. You can see the scale of this capital shift playing out in the transatlantic commercial property sector, directly altering the skylines of major financial hubs. Traditional office buildings in places like London, Paris, and Frankfurt are experiencing severe yield inversions. The combination of altered corporate occupancy baselines and high debt refinancing costs makes holding on to traditional office real estate a losing mathematical proposition. Institutional asset managers are cutting their losses. They are freezing traditional metropolitan developments and aggressively liquidating their existing office footprints entirely. The capital freed up from those empty towers is immediately being redirected to fund the construction of highly automated cold storage facilities and massive enterprise AI data logistics centers. This demonstrates the widening gap in the current economy. To survive the friction of high rates and trade wars, the corporate world is liquidating traditional office assets to fund highly automated data logistics and artificial intelligence infrastructure.